All right, good evening, everyone, and thank you for joining us this evening. We're excited to bring to you the session on closing the tech funding equity gap, focused on creating opportunities for founders and funders. Before we hop in, I'd like to introduce myself and the Carlson Center, as well as tackle some brief housekeeping, and then we'll get rolling with the main session with our key speaker, Mariah Lichtenstern. So my name's Cameron Law. I'm the Executive Director of the Carlson Center for Innovation and Entrepreneurship. We serve as a regional hub and platform providing approachable and accessible entrepreneurial education, community, and support to startup founders of all backgrounds to explore and launch their businesses. The Carlson Center not only serves Sacramento State community, but the greater Sacramento region. And really under President Nelson's leadership at the university, he's really pushed forward this notion of the anchor university. And a key component of that anchor university is the Carlson Center's work to promote innovation and entrepreneurship. I know some of you are asking, what does anchor university mean? And President Nelson's words are, an anchor university is the opposite of the ivory tower. It aims to connect its students, faculty, and staff with the community, and in turn help build and heal that community, achieving lasting solutions and improvements through inclusive civic engagement. And so really a core focus for us at the Carlson Center is to promote that work and to really engage with community and recognizing entrepreneurship is a key vehicle to wealth accumulation, which will be key in addressing inequities and really focusing on marginalized communities. And so we're really passionate about that work, and one of the reasons we partnered with Mariah Lichtenstern here today is to provide more access and opportunities for underrepresented and underinvested founders, that being Black, Latinx, and female founders. And so we're really excited to bring this event to you. It's one of our kind of speaker series ecosystem partner workshops, and for us is a great way to continue and push that work forward. So without further ado, it's my pleasure to introduce Mariah Lichtenstern. I'm going to give you a long list of amazing things that she's involved in just to show you the way she's not only impacting entrepreneurship here locally, but throughout the nation and beyond. And so she's the founding partner and managing director of Diversity Ventures. Additionally, she recently served as a fellow for the Aspen Institute's Tech Policy Hub, where this research came out of, and really exploring underrepresented founders and fund managers and accessing capital. In addition to those roles, she's the founding and managing director of Founders Institute's Sacramento chapter. She's a board member of Fourth Wave. She's a technology advisory committee member for Cal Seed Fund. She's an advisor to Berkeley Skydeck, Yale advisory board member for Diversity, Equity, Digital Health, and lastly, an advisor to Village Capital. So you can see she's working across the nation to advance these goals around equity and inclusion, and really realizing and working in that space of entrepreneurship and seeing that as a key vehicle for supporting marginalized communities. And so without further ado, I'll pass it over to Mariah, and as she's uploading, I think she's going to share her slides. A little bit of housekeeping. Please remain muted during the presentation portion. We'd love for you during Q&A to be unmuted and ask your questions, but just for recording purposes would be great if you remained muted. And then if you have any questions as the presentation is going, please raise your virtual hand. You can click on participants and then raise your hand near your name, or you can also send me a personal message with your question and I will filter those into Mariah. But I will pass it on over to her and we can get started with today's session. So thank you all for being here.
I want to thank you, Cameron, for facilitating. You are such a tremendous resource in our community, and you're always so supportive of entrepreneurs and the ecosystem builders. So I just want to thank you 1,000 times. And I want to thank all of you that have joined in today. And I really hope that you guys bring your questions, because I can wax poetic about this stuff and share with you all of my thoughts and ideas around this subject. But what I really, really would value is hearing from you what your thoughts and concerns and experiences are. So please don't be shy. And I promise you, you can ask the tough questions. I will not get offended. If there's something that I don't have an answer or a perspective on, I'd be happy to get back to you. And I've included my my contact information in the slides that I'm going to share with you. So please, please don't be shy. And do add any comments that you have in the chat, and I'll try to look at them. Oh, well, thank you, Lauren. You're one of my favorite people too. I don't get to see you enough. So with that, let's see if I can share my screen with you. Okay, are we all on this? Can you see my slide?
Yep, I can see your screen.
I think that's Zoom etiquette now. Can you see my slides? So, so the problem that, as Cameron mentioned, I wear a lot of hats, but Q1 of this year, I decided to invest a significant amount of time, 10 weeks in residence in San Francisco as an Aspen Tech Policy Hub fellow. And the first 4 weeks was policy boot camp through a fire hose, you know, all day long. And in the last 6 weeks, we identified a policy problem that we wanted to address and set out to create outputs that would support solutions for that. So the problem that I set out to solve was closing the tech funding gap. And what the tech funding gap is, as Cameron mentioned earlier, is the disparity that exists, particularly for underrepresented founders in the amount of capital that they receive. But I do want to emphasize that we do have the largest wealth gap and the largest income inequality that we've had in this country since the Gilded Age, since prior to the Great Depression. And this is something that impacts all of us. And so hopefully we'll be able to touch more on that. But there are a lot of Americans and aspiring founders who are impacted by the funding gap. So anyway, as I mentioned earlier, the venture capital backed startups have disparities, and this is the way that it impacts those of color. Only 1% of venture capital, of venture backed founders are Black, and 1.8% are Latinx. When you look at venture capital backed founders, 82% are all male teams and 6% are all female teams. However, we know that this is, you know, that VC is not a meritocracy. There's been a myth that's been perpetuated that it is, but Kauffman Fellows research has recently put out research that shows that ethnically diverse teams outperform their all-white counterparts when it comes to realized returns. So that's not the reason why this disparity exists. We also have research that's been, you know, cited quite frequently that the likelihood of companies that have gender diverse teams to outperform is very high, and it's even higher for ethnically diverse teams. Now, as I mentioned before, this impacts all of us. So these discriminatory financing practices actually cost the United States 9 million jobs and over $300 billion in collective net income on an annual basis. So it's not just affecting underrepresented founders and funders. We do focus on venture capital because the bias is clear there. We have the research. These are the venture capitalist demographics, 82% male, 70% white. You can see that Black and Latinx are hardly on the scale. And they tend to back founders that are like them. And it's easy to be frustrated with this and, you know, cite the bias and the racism that, you know, we hear about frequently. But a lot of this is also just a function of networks. And it's not only on the founder side, it's on the funder side. Venture capitalists tend to hire people that also look like them. So only 2% of venture capitalists are Black, 1% are Latinx, 18% are female. So we like to, you know, just think that this is very simple. You know, VCs need to invest in more women and more underrepresented founders, but there's actually systemic barriers that start even before founders reach a venture backable stage. And that is in bootstrapping and the friends and family round. So when we look at the sources of capital for startup founders, $500 billion a year goes into startup founding. And of that, 60% comes from bootstrapping. This is founders' own capital, their credit cards, their equity, their personal savings. 38% comes from the friends and family round. And less than 2% actually comes from angels and venture capitalists. So part of the challenge is when it comes to raising a friends and family round, no one can stop you from investing in your own company, fortunately. But when it comes to the friends and family round, there are regulations in place that limit who can invest in startups. Most startups and venture capital funds actually are, they raise capital under Reg D. So that's a rule and regulation that is governed by the Securities and Exchange Commission. The Securities and Exchange Commission is a federal agency that governs securities laws. So these are some of the types of offerings that startups can use to raise capital. And the most common, the most preferable offering type is Reg D. Unfortunately, under 506B, you can only have 35 non-accredited investors, and under Reg D 506C, you can't have any non-accredited investors. So what does that mean? Okay, so here's the definition of the accredited investor when it pertains to individuals. And some of you may know that a new rule came out from the SEC last week that updated the accredited investor rule. It did not change this aspect of that. So currently, the accredited investor definition requires an investor to have made $200,000 for the last 2 years at least, be expected to continue making that much, or they can have up to $300,000 in the household. And one of the updates that came out was that they changed the wording so that it can include couples that aren't male-female. So that's an improvement. The other alternative is having $1 million in net worth, which excludes the family home, and that has some significance as well. So here's the sad fact. Most Americans don't qualify. And so, I've yet to see the estimates on, how the number of accredited investors will increase under the new rule. I don't think it will be very significant. It'll essentially boil down to how many Americans have a Series 7, 65, or 82 designations, and a couple other nuances. But basically, less than 15% of Americans have the freedom and discretion to invest in the private market. Of that, 1.3% are Black and 2.3% are Latinx. So I was talking to someone, I was actually talking to a journalist the other day, and they looked at this and they said, okay, so 1.3% of prospective Black investors and 2.3% of Latinx can invest. No, that's not what this number is. This is 1.3% of what the NASAA estimates is 16 million Americans. So 1.3% of that are Black and 2.3% are Latinx. So it's a very small percentage. It's a very small percentage of Black and Latinx investors that underrepresented founders have to tap into. And by the way, 22% are female. So why is this? And what's causing this? And essentially what it is the wealth gap that I referred to earlier. The average white household wealth is 7 times that of Black households, and it is 5 times that of Latinx households. And if we look at the median, it's even greater, 10x and 8x respectively. So unfortunately, this exists due to persistent disparities that basically were put in place back in the New Deal era during the Great Depression. There were systematic policies that segregated Americans and made it harder for minorities, as we are sometimes called, to build wealth. So this is where we stand. So the mission of the U.S. Securities and Exchange Commission is to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. But unfortunately, this definition falls short. And as I mentioned earlier, it's partially a result of economic engineering. And this accredited investor definition is essentially the equivalent of what redlining is and was in lending policy. So a little bit of background on redlining. I know that more Americans are becoming aware of it, but earlier when I mentioned the Great Depression era, essentially Theodore Roosevelt implemented the New Deal, as many of you know. If you remember history in high school and we're taught this. And part of the New Deal involved creating several agencies. So when it comes to redlining, the Federal Housing Authority and the Homeowners Loan Corporation were responsible for putting the policies in place that led to redlining. And so what this did is, you can see maybe in the background that there's a map here, and this is an example of how it worked. And so the areas that are in red are communities where it was predominantly Black. And these were listed as high risk, even though there were not any facts to substantiate that. There were explicit covenants written that prevented people of color from living in predominantly white communities, that prevented lenders from loaning to Black families, prevented them from loaning in these communities that had predominantly Black populations. So people of color were locked out of building wealth in the real estate industry. However, white people were allowed to build wealth in this way. What else happened during that time is that the SEC was formed, and another organization called the NRA, which is not the NRA as we know it today with the National Rifle Association. It was another recovery agency. And so the SEC implemented a whole host of protections to prevent the 1929, what led to the 1929 crash, which was insider trading, bad actors, institutional bad actors. And within that series of laws was an accredited investor definition. And it became dog whistle investor protection that prevented the vast majority of Americans who weren't part of the wealthy elite from investing in startups. And while it was not explicit in its racial intent, they knew that it was going to impact both Black and white investors, but that it would impact Black investors more. And this was in an era when they were destroying Black Wall Streets across the nation. But what they did as an appeasement was allow white people to build wealth in real estate. So this is what led to the current situation, whereby underrepresented founders, especially those of color, have less sources of capital. And so naturally, because there are less Black and Latinx investors, or qualified accredited investors, it's much harder for underrepresented founders to raise friends and family, even though there are certainly people from those communities who can afford to invest, who have the sophistication and the risk tolerance, the desire to invest. And so unfortunately, when we hear stories of people like Jay-Z, there's a very salient article where he talks about having a window where he sold drugs. And he said, it's a very narrow window because you know that you're either going to die or you're going to go to jail. And so you want to convert that over into a legitimate business. And he lists the types of businesses that you could invest in, a car wash or something of that nature. What you cannot do is invest in startups. So that still persists under the current rules. And again, it's touted as investor protection, but this is a misnomer for perpetuating the wealth gap. And, they often say, well, the average American just is not sophisticated enough to participate in the private market. The public markets are much safer because they're liquid, but that liquidity is also what leads to volatility. And so when we look at 2008, you can see here that we lost 16.4 trillion in net worth and 2 trillion in retirement when the stock market crashed. And you've never seen anything of that magnitude in the private market. Now, most startups fail, and not every company is going to be successful, but the reason why limited partners invest tens and hundreds of billions of dollars in venture capitalists to invest in companies is because, you can, with one win, make up for a multitude of losses and return a multiple on the fund. And this is just an example. There was a venture capitalist who published how he still hasn't gotten over that he had several opportunities to invest in Uber, and a $250,000 early investment at the time when he had the chance would have resulted in a 1 billion plus return. Okay, just one investment at 250,000, a billion plus return. Some people put in as little as $10,000 into Uber and they became millionaires. So imagine, if you are a sorority, a fraternity, a community that pulled resources to invest in an early round of a company that has a trajectory of Uber, it would make up for a multitude of losses. Now, this is capital that people, do put at risk. You have the risk of losing the entire investment, but I would argue the same is true in the public market. And actually, there's been some recent research that came out that said that private market investments are actually, they are preferable and offer more security during down markets and times of instability, like what we've seen now with the pandemic, what we saw in 2008, and certainly in crashes of the past. So I don't know if anybody else has ever contributed to philanthropy or contributed to like a building fund at their church, but the question is, why is it that we have the autonomy to spend, but we don't have autonomy to invest? No one's going to stop you from going to Vegas, from taking a trip around the world, from tapping into your 401k to bet on your kids' college education. There's a whole host of things that we can do and have autonomy to do, but when it comes to investments, we are literally handcuffed. And startups cannot make offerings to non-accredited investors unless they use crowdfunding, which is separate and unequal. And although there are wonderful companies that use crowdfunding, it does not replace a friends and family round. You typically have to have between $20,000 to $50,000 just to have a successful offering on a crowdfunding platform. So is paternalism the best policy to say we are protecting investors from their own financial decisions? There are disclosures that are required for startups that are exempt from registration in the public markets. There's no exception to that. You have to provide non-accredited investors with even more disclosures under the rules that currently exist. So there are protections in place, and the SEC frankly could do more to help educate investors about investing in the private markets, but they're choosing not to do that. So at the end of last year in December, the SEC proposed to update the accredited investor definition to increase access to investments. And one of the solutions that I am proposing is that they eliminate the financial literacy test for accreditation. That includes the net worth and income requirements. It also includes having certain FINRA licenses or meeting other criteria, because just as Americans go to advisors, go to their CPAs, go to trusted attorneys for advice in other matters, my belief in conviction is that they should be able to do the same when it comes to financial decision making. And I will say that I was personally FINRA licensed, and I sat in the households of Americans, and many Americans cannot afford to invest in a startup to the extent that they would be able to get into many offerings. Some people are living paycheck to paycheck. 70% of Americans are living paycheck to paycheck, and they're not investing in the stock market or anything at all for the most part. However, I know from sitting down with people in their homes, they invest in real estate, they invest in bonds, they invest in other illiquid assets. And Americans are smart enough to make decisions on what they want to do with their money. And they are smart enough to seek advice, and they should be given access to information that will help them identify fraud so that they won't fall victim to it. Right now, as it is, because Americans are basically kept in the dark. I mean, we learn about a lot of things. I took pre-calculus in high school and in statistics, but I didn't learn how to do taxes in high school, and I didn't learn about investing in high school, and this is basic math. I mean, we won't get into derivatives or anything of that nature, which are offered on the basically on the public market, but the math when it comes to startups is not sophisticated, as many of you who are entrepreneurs on this webinar know. So last week, the SEC actually did come out with a new rule, and they did make some modernizations, but it failed to address the iniquities that exist, that date back to the New Deal, that are reminiscent of the redlining that existed up until 1968. It still exists today, but it was made illegal in 1968. But this still remains legal to discriminate on the basis of income, net worth, and financial sophistication. So what are the next steps? There are Americans have the right to petition. There are petitions listed on the website here, the SEC. And at any time, Americans can petition the SEC to change rules. So I have prepared a petition, and I'm launching that out to people now. You can go to techfundingequity.com. You can sign the petition from there. You can see it and sign it. There's a longer comment that accompanies this, and you can also sign up for updates by subscribing to get access to that and other material. Now, not everyone agrees that Americans should be allowed to have financial autonomy. One of the greatest and most influential opponents of extending the definition of accredited investors is the North American Securities Administrators Association. They govern beyond the US, but they are considered the states' rights version of the SEC. They actually were around 20 years before the SEC. And I would argue that had they really done their job of protecting investors, we wouldn't have needed the SEC, because the SEC was formed again to address the causes of the stock market crash. But this is what a statement of someone, Christopher Gerald, the president and chief of the New Jersey Bureau of Securities, he stated, "It's implausible that 16 million American households currently have both the financial sophistication and the capacity to bear the kinds of investment losses that courts and prior commissions have considered essential prerequisites for participation in private offerings." So this 16 million people that Christopher was referring to are accredited investors, people who meet the income and net worth or net worth thresholds. Now, just a little context on what the North American Securities Administrators do. They actually put out the tests. They govern advisors who advise, just like I did, who advise Americans on how to invest. When fraud is committed, they oversee that. They get paid for the tests that we take to get our certifications. So when the new rules came out and said it expanded the accredited investor definition to include those who have completed the Series 7, the Series 65, or the Series 82, they will benefit from those who pursue that because they want to become accredited and they don't have another means to do that. Now, if any of you have taken any standardized tests, I've sat for the Series 7, I've sat for the 65, I've sat for the 6 and the 66. Extensive study has to go into this. The tests are several hours. They are not inexpensive. And these types of tests are reminiscent. In fact, they're even more complicated, but reminiscent of the voter testing that was required for people to have autonomy to participate in the civic process. This is the equivalent of having the autonomy to make financial decisions. So that's what they said before the rules came out, or at least what some people were quoted as saying. And I put a link here to this article that I pulled this quote from. Now that the SEC has come out with the new rule, this is the response. This is an excerpt from the response from the NASAA. The SEC should focus on growing and promoting the public markets rather than incentivizing issuers to raise capital in the private markets. Further expansion of private markets comes at the expense of the public markets, which are essential to the health of our economy. So I want to just pause there because it's a lot to take in. And I do want to emphasize that every company on the public market was once a private company. So there's that. And there are reasons why they're concerned about the private markets, because increasingly companies are staying private longer. There are alternatives to the public market that are coming out. But again, the NASAA benefits from relegating everyday Americans to the public markets. So we'll come back to that shortly. This is the second part of what they said. The commission had the opportunity, but once again failed to protect seniors or other vulnerable investors from the inherent risks associated with the lack of transparency and liquidity that exists in the private securities markets. I would argue, and I'm very interested in hearing your thoughts and experiences and ideas on this subject, that there is potentially more transparency in private companies, in that if you are investing in a friends and family round, you know the founder. You know if they're having a bad week, potentially, or if you're a little bit more removed, you know generally what's going on with them, if they've just had a baby, if they've had a car accident. Hopefully you're getting updates on that company on a quarterly or monthly basis in their earliest stages. You can pick up the phone and call the founder or email them. So And then there are, again, disclosures that are required when you make offerings. So, but this is what they've said. And I just wanted to share this with you. Someone had actually shared this with me. This is an excerpt from the movie, The China Hustle. And so it's got a couple of rough edits in it, forgive me for that, but I wanted to share this with you for educational purposes.
How much was stolen from each pension fund, each retirement fund, each of us? The real story is the aggregate value. It's the investors who by the end were mostly retail investors. These were mostly just people playing the American stock market who looked at the financials and believed them.
That money is money that belonged to individual mom and pop investors.
But I would pay, if I have my money in Fidelity, isn't that what, why do I pay these guys?
I don't pay them. I don't give them any of my money.
It's like a game of musical chairs. When the music stops, if you're left holding the paper, if you're left holding the shares, you're the victim.
Okay, my name is David G., and I live in Atlanta, Georgia.
My name is Ray Snyder. I'm a print and broadcast journalist in Newport, Tennessee.
Tom Snodgrass from Spring, Texas.
I was hoping to have a nice retirement egg for my wife and myself. I do not have a retirement plan at my job. My wife doesn't have a retirement plan at her job. Roth Capital issued a buy recommendation.
The first company that really kind of caught my eye was AgFeed. Allegedly, they were the largest feed producer in China.
My last shares that I purchased were $9 a share. We recouped 12 cents on the share, and we had a total of about 26,000 shares.
What kind of loss did that represent for you personally?
It represented about $150,000.
I think I lost well in excess of $100,000.
My investment in these U.S.-listed Chinese companies represented at least 50% of my assets. The prices tanked, and they were eventually delisted and not tradable.
Worth zero.
Worth $0 per share.
We put our faith in the market, in our government to police that market. And I think we got burned on literally every turn in that particular transaction.
Roth Capital issued a buy recommendation. I'm not sure that they visited the plant at all in China. In fact, today, I'm not sure that it was a China Electric Motor Company.
How old are you, Ray?
I'm 68 years old.
So where did the money go? To the bankers and lawyers who helped set up the deals. And to the Chinese executives.
Okay, so we'll pause it there, and I just want to reiterate that this is a public market, and right now what the NASAA is saying is that the Securities and Exchange Commission, in updating the rule, as marginally as it did, to only really include people who are getting licensed by them, and a few other exceptions, they are saying that the SEC is failing to protect seniors and other vulnerable populations. But as you can see here, there are seniors and vulnerable populations who are being defrauded in the public market. And right now, they mentioned the bankers, they're referring to investment bankers, and these are people who are licensed and registered broker dealers. And this is not everyone. There's amazing broker dealers and advisors, and God bless them. They sit in living rooms, they go over budgets, they help people make wise decisions. But there are people who are committing fraud, and it's more extensive in the public markets, and there is no accredited investor requirement on the public market. So the arguments just don't weigh out. Americans who are more sophisticated, who are more educated, who are more practiced in investing in private market companies are more likely to participate in the public markets and be more informed and a little more diligent. And I think that's what the real concern is. That's my opinion. So this is part one of our solution, and part two, as we mentioned earlier, has to do with the venture capital industry, where we know bias exists in funding underrepresented founders. And so solution two includes the opportunity pledge that has a goal of increasing investment to underrepresented founders and fund managers 10x by 2025. And this includes a framework to help provide for support and sustained effort. These issues when it comes to racial inequity and social injustice are very uncomfortable. You know, I, as a person of color, live day to day in this avatar. And I can say, you know, I don't have a choice. I don't have the privilege not to care or not to inform myself of how to overcome the barriers that I face, particularly in this industry. But there are many who have been comfortable with the privilege of not having to discuss or deal with it. And I understand how uncomfortable it is because I experience that discomfort as well. And I've overcome it to a certain extent, but even seeing everything that's going on in the news today and that's been happening over the past months, it continues to be painful. And so I think we all would benefit from reciprocating empathy towards each other. And that's what this is designed to do. It's not about naming, blaming, and shaming. It's about creating a framework so that companies don't have to reinvent the wheel, and supporting them in achieving results and sustaining results. And this is for both venture capitalists and the limited partners who invest in them. And so in terms of next steps, you know, we are building out our advocacy partners and we are coalition building. And for those of you on the call, again, I invite you to contact me, to go to the website, techfundingequity.com, subscribe to the updates, sign the petition, inform yourself about these things that, you know, really go under the radar. I've included some infographics to help simplify some of the concepts, because they really do hide things in this tangled web so that people won't find out what this engineering is about. But it is very much economic engineering. And I fear that if we don't become more aware, particularly as founders, as ecosystem builders, and people like, you know, the VC firms, limited partners, accelerators, angel groups, if we don't know what's going on, and if we can't speak to it, if we can't advocate for it, if we can't leverage our collective power to move Congress to address these issues, to have oversight, then we're all vulnerable to another collapse. And right now, some of you may have seen that the stock market is performing disturbingly well given the pandemic and the state of the economy. And we have the lowest level of insider trading oversight and prosecutions that we've had in 30 years. So those are some statistics that alarm me and that I'm concerned about. And I'm concerned with the current state of the administration over at the SEC, and whether there is the motivation to have greater oversight and to prevent another crash like we've seen in the past. So with that, I want to thank you for allowing me to share this with you. And I do hope that you have questions or comments. I think I saw some chat things pop up, but my screen is mostly the deck. So with that, I'll turn it back over to Cameron.
Awesome. Thank you, Mariah, for sharing your wealth of knowledge and providing us with some tangible solutions and taking next steps and bridging these gaps and, you know, really moving forward and trying to address these inequities and really trying to provide access to capital for underrepresented and underinvested founders. So I'll kick off a couple questions. I know we do have a couple in the chat, but want to give some space for people to digest that wealth of information. This isn't the first time we've had the conversation, so I've been able to digest it over, you know, a number of weeks. But the first question, you know, we've had some conversations, and you know, one of the things that we really always kind of talked about was the, you know, economic opportunity and really looking at it from not a zero-sum game, and particularly with the performance of women and women of color founders. And I'm wondering if you can kind of speak to some more of those like numbers and what that like economic imperative and truly like what potential that unlocks if we're able to get more investment capital into these underinvested founders.
Well, one thing that I'll say is that Black women they are statistically the fastest growing, most educated population in the US. Oftentimes, people point to a lack of education, a lack of mentorship or knowledge or skills. In the Kauffman Fellows research that I mentioned earlier, they actually found that the education among Black and Latino founders, and not even founders, just in general, is increasing both on the undergraduate level and in graduate degrees. And the number for their white counterparts is actually going down, where theirs is going up. But the increase in education has not translated to an increase in hiring. So we can attribute it to like a lack of education. So I'll say that. And there's a movement going on. And I'll also point to Steve Jobs and Mark Zuckerberg, who are college dropouts. I'll mention that as well. But there is a hashtag trend that started a couple of months ago, hashtag hire or wire. And it points to the fact that oftentimes when it comes to people of color, there's an abundance of willingness to offer advice and mentorship, but not so much to write the check. And so, I think a lot of that just goes back to a cognitive dissonance in terms of, pattern matching. When you are comfortable with what you've been taught and told and what you see, I think it's challenging when you see something that doesn't align with that. And, Cameron, you and I know, going through the Fourth Wave Accelerator, the training with Authentic.CEO, when it talked about, just a cognitive dissonance in the way that our brain distorts things that produce these optical illusions. And so, unfortunately, even though there is certainly a pipeline problem in that, because of the lack of friends and family and wealth in communities of color, there's not as many founders making it to the venture backable stage. Even those that do are not funded to commensurate with their representation in that group of founders. So, as I mentioned earlier, I think it was like 1.3% of venture-backed companies are Black, and the percentage of founders that are in Crunchbase that are Black, according to the Kauffman's research, is somewhere around 2%. So it's still falling short, and that's the status quo. So unless there is something to disrupt that pattern, there's just people are going to continue with the status quo, and I think we've seen a lot of the zeitgeist of today calling for that change. And so I think this is timely. I think that change is happening now in the way that it did during the civil rights movement. But, we can't be passive about it and pass the buck or bury our heads in the sand. It's going to take collective effort.
No, definitely. And you're headed in the right direction of what I was thinking in terms of kind of the next question around pattern matching. I was thinking exactly around the fourth wave conversation, and really looking at it again through that like economic lens of, traditionally when you're investing, sometimes you don't always know the best solution, right? And recognizing that if your patterns being in that kind of comfortable space, that you might miss out on some of those returns. And so I'm curious of I know you have some strategic partners through the Opportunity Pledge, but curious of kind of how you're, what some of the solutions in that pattern matching state for, expanding that 10X Opportunity Pledge. I know M-Train and other resources like that. What are some resources, we as either ecosystem builders or people can start to promote to, further educate our venture capitalists and angel investors?
Yeah, you're incredible even for hosting this. This is amplifying the message, right? And I've really enjoyed the conversations I've had with M-Train, who, for those of you who don't know, is a local company that went through the first cohort of, I think they are based in Silicon Valley, but they went through the fourth wave cohort, the first one, and I think they've just raised $10 million. But it was bootstrapped for a very long time, female founder, Jenny Yancey. And what they do, they help companies with compliance, with harassment, anti-harassment, and diversity, equity, and inclusion, which is also known as DEI. So I love that they take a holistic approach and they provide technology that allows companies to benchmark, and that aligns with our framework, which is not to I know there's a lot of people who want the report card and they want to blast it out there. That's not what we do. Not to say that other people should not do that. There's a place for different methods, but our framework is to provide data internally, to do quarterly check-in on how the internal activities are helping or not helping, if things need to change, and then to do an annual check-in with the Tech Funding Equity Project. And companies can choose to publish that information if they want to. But in terms of, I think one of the most important things is to expand the network. And so by recruiting more underrepresented fund managers, by doing scouting programs, by doing venture partnerships, they're allowing underrepresented founders who would not normally be able to enter the industry to establish an attributable track record, which is one of the requirements when LPs consider funding a fund manager like myself. They want to look at your track record. What have you invested in before? How has it done? They look at things like how much personal wealth have you contributed? So there's barriers to entry that impact people of color coming from this wealth gap and not being hired equitably by venture capitalists, which have no oversight when it comes to diversity for the most part. So this is, creating a framework by which they can start to build those connections, and through, these scout programs and venture partnerships, they now cast a broader net. I know that, people come to me and they say, it's just so hard to find women in cybersecurity. And I'm like, well, let me just introduce you to Carmen over here. She has a whole organization full of women in cyber tech. It's not a problem for me because I have a more female-oriented network, or at least a diversified network that includes more women that I happen to know. I don't necessarily golf with them, but oftentimes just the way that we network or fail to network and some of the other dynamics that exist, they limit who we're exposed to. And so part of the Opportunity Pledge is designed to expand those networks. And that's just one of the ways. So we have a couple of accelerators signed on. We've had a couple of venture capitalists join. They're trickling in, and I'm really excited about that. And we're starting with those who have expressed desire to support diversity, equity, and inclusion, and we'll expand from there.
Awesome. Thank you for that. I have one kind of last question, and then we'll open it up for the Q&A. And I know there was, I think, a few in the chat that we can head into. The last kind of question I had was around kind of what the SEC rolled out in terms of their accredited investor kind of new ruling or their adaptation. I know it's progress that they've, I guess, started to address the issue, but obviously is a long way from where you want to be or where we want to be. And I'm wondering kind of like, what does that look like in that, not necessarily dream state, but when we start to get closer, what does that kind of look like from the SEC lens? Is that a fundamental like shift in policy, or what does that kind of success look like?
So it's interesting because the chairman of the SEC was recently on, a webinar with Culture Shift Labs, which is an organization formed by Andrea Hoffman, co-founded with Denmark West and others, that works with underrepresented groups in technology, and that includes venture capitalists and limited partners. It really facilitates those kind of connections. And so he did an event with them. It wasn't promoted on the SEC site for some reason, but I was able to sit on that. And one of the things that they expressed was just not knowing how to roll out the expansion. And so, my response was, well, here's this trusty solution. This is what we were in the Aspen Tech Policy Hub to do. And in the Aspen Tech Policy Hub the first cohort, there was a team that did a project about, elders online. And they found that, they found an example of a FBI form that was just really difficult for elderly Americans to read and to use. And so they did some testing. They used, tech industry best practices or better practices to test the user interface when it came to older adults. And they proposed their recommendation to the FBI, which ended up implementing that. So my hope is that the SEC likewise looks at how simply they can allow Americans to self-certify as accredited, And, it can be just a couple of check boxes that say, I understand I can lose all of my capital. You can certainly lose all of your capital on the public market, as we saw. I understand that this is a liquid investment, that I can't cash it out tomorrow. I am able to sustain that risk. I have access to advisors, whether that's lawyers, CPAs, advisors who are licensed. I think there's a place for advisors who do understand securities law and regulations and can advise people that, hey, this company that you're looking at, it didn't check this box when it comes to compliance, and the exemption requirements. They didn't make this disclosure, or they're claiming that you're going to be guaranteed a 4,000x return. That's fraud, right? So even on the SEC's website, they can provide that information. They can provide a checklist that says, hey, these are indicators that, this company is making a fraudulent offering, or they're not complying with the exemption requirements. It's not rocket science. When it comes to what the rules say must be disclosed, oftentimes they're one sentence or a couple of sentences. And you could certainly have a lawyer or a CPA explain what that means and help to evaluate if you don't want to do it yourself, or you just want a second look. But for the most part, people who are exposed to these kind of opportunities, they already are probably at a level of sophistication. And I know we have crowdfunding, which is, again, they're typically not your friends and family in your neighborhood or people and they're typically not the earliest stages. So, I just was looking at a crowdfunding offering the other day, and, the valuation was extremely high. The share price was relatively high for an early stage company. When you look at a Reg D offering, it's typically like literally a fraction of a cent, right? So when you saw the guy in the video talking about, I invested in this company at $9 a share and it went down to 12 cents. That was a huge loss, right? But when you're investing like in a typical, like really, really early stage friends and family round, you're talking about a fraction of a cent per share. I recently purchased some shares for I bought like 20,000 shares for $2, literally. So really no place to go but up. And, just imagine what $2,000 would have bought, right? And if I can afford to lose that, then, it's no big deal. But if that company is successful, has a successful exit, it's a very, very big upside. And that's what we're being locked out of. So, a little bit circular, went off on the tangent there, but I hope that kind of addresses.
No, and I think one thing that it clicked for me was kind of, successful founders that exit, they come back and reinvest, right? And so once you've kind of created that cycle of, under-invested founders and, ones that, Black women, Latinx founders that now will have these successful exits, now they can invest and future founders as well. So it's kind of that success begets success. So
exactly, that's what happens. So if you look at like a Mark Haney, look at the amazing work he's doing in our ecosystem, right, because he's a successful founder and now he's giving back. And a lot of, I spoke with a VC this morning who, he published a really insightful post about, the wealth requirement for emerging managers. And I was asking him about his background and how he developed that insight. And we talked a little bit about the policy stuff. And he said that, we've lost the cultural context. We don't have a cultural memory of where these rules and policies came from. So when we hear investor protection, it's a dog whistle. You don't hear the underlying context that was designed to prevent that wealth creation in the Black Wall Streets, in these communities that weren't part of the upper echelon. The reason why the public market worked to create so much wealth for certain people, like the first chairman of the SEC, who is Joseph Kennedy, fascinating story, people. He actually generated a lot of wealth because of the lack of regulation in the stock market, and he made the practices that he used to generate a lot of wealth illegal when he became the chairman. How did he become the chairman? He was appointed by Theodore Roosevelt. Why was he appointed by Theodore Roosevelt? Because he gave a lot of money to him to run his campaign. So this is how the things work. These are networks. When you look at who's over the SEC now, what did he do in the past? Oh, he was a securities lawyer for the Alibaba IPO, and then he was appointed, to this role, and now he's you know, being, he was put up to be appointed to the role of the prosecutor in New York. When you start going down these rabbit holes, you start seeing that it's a small network of people. People on Wall Street know each other. They know the players. Bernie Madoff was the chairman of NASDAQ. You know, like he was a god on Wall Street. So when Frank Casey and others reported him 5 times over 6 years, and the SEC failed to investigate, to even just do their basic diligence to ensure that what was being shared with them was or was not true, they failed to act. So, you know, these laws and policies are meant to benefit a small network. And when that's broadened, then it gives the base more power. And that's just not something that everybody wants. And so while some of it is unintended consequences, there is a constituent that to this day has a philosophy around who should have access to wealth creation. And I, like you, Cameron, believe that, you know, that the amazing people on this call, the amazing founders I see in the ecosystem should be empowered to go and build their companies and fail forward. And by the way, a lot of times if you've invested in if you invest in a company in a friends and family round of someone you know and it fails, they'll come back and say, hey, you know, what you contributed before, I want to grant to you in shares in my new company. And they might succeed having learned from their past mistakes. That is a common story in startup land. And so, you know, I just think that there are so many benefits to opening up financial autonomy for Americans, and we don't have to sacrifice legitimate investor protections. And to your point, yes, we will come back as founders, as fund managers, as investors, and take our gains and continue to give back into our communities. One founder that I talked to, Joel Burke-Solomon, I know she gets tired of me saying her name, but I just love her story so much. She sold her company to Park, but she went 3 years, you know, and I talked to her first institutional investor, which was Comcast, and you know, Will Crowder. He said, you know, we tracked her for 3 years and we wanted to invest. We knew she was amazing, but we don't write the first check, you know, and now look, she's exited and she's, you know, sold her company to Amazon. And she's told me personally the story of how some of the people that were, you know, part of her founding team, some of the early shareholders in her company that were, you know, internal hires, that, you know, they've been able to go and buy blocks in their community and to rehabilitate and, you know, revitalize their communities because they're millionaires now, you know? And so that's what, you know, every community should be able to do. And right now it's just very much concentrated in a few ecosystems, you know, 13%, you know, that 13 to 15% of Americans that are accredited investors and those adjacent to them.
Thank you, Mariah. Alrighty, I'm going to turn to the chat now. So the first question I know was from Laura. She had a question in relation to the statistics for startup funding. So you said like 60% is bootstrap, 38% is friends and family, and then less than 2% is angels. She was wondering what like universe is that, like part of like the seed rounds, or is that all startup investment, or is that series A, B, or C? What kind of like universe was that in?
This is startups, and generally not just specifically tech startups. And so, you know, most venture capitalists invest in tech. So that's part of the reason why there's such a drop off. And then even in tech, you know, most companies don't get venture backed, and many companies don't need venture backing, to be honest. And I'm the first to say, if you don't need venture backing, don't take it, because now you're beholden to your investors and you have to move really, really fast. And if you're not ready for that, don't do it. So that statistic is for all startups.
Awesome, thank you. The next question was from Sonia. Can a non-accredited investor invest in a venture capital fund?
The short answer is no. It's one of the exclusions. Well, there is an exception. So when I mentioned Reg D 506B, and I'm not an attorney, so this is not legal advice, consult with your own attorney, but under Regulation D 506B, up to 35 non-accredited investors can invest in that type of offering. However, the issuer, who is the one raising the money, must demonstrate that that investor or those investors are sophisticated, which means that they have enough business and financial knowledge and experience that they don't need the protections of, you know, registration that fall under the SEC. But when it comes to like crowdfunding, you can't crowdfund for a venture capital fund. There's no safe harbor for that. So I know that there is, you know, there are people who are trying, but, or at least one that I know of, but, you know, the regulations don't have a safe harbor for that. You have to jump through a lot of hoops. Right. And if it's on a registered crowdfunding platform, it probably does not comply. What is that threshold for sophistication? That was just a follow, and there is none. So there is none. It's not defined. So it's not. It's just, yeah, it's arbitrary, and that's one of the things where the SEC can empower people to become more sophisticated, right? They can provide it. Trust me, I've seen the Series 7. It's not going to help you evaluate startups and make a good decision. I mean, by and large, it'll teach you a lot about what the rules are, and you might be able to identify if a company is running afoul of those. But you could get the cliff notes for that, as far as I'm concerned. You know, you shouldn't have to sit for a 3-hour exam to understand the red flags of a company that's committing fraud. But it's not going to, you know, help you read a PPM better or something like that. It's not going to help you understand a deck better. If you go to the boot camps that you've been doing, Cameron, then you might be able to, you'll develop some sophistication. That's what it really takes, is exposure to these kinds of ecosystems, and they can be very grassroots. You know, it doesn't have to be something that the NASAA, you know, cashes in on. Yeah, that was actually a new learning for me, was thinking of it through the business model of the accreditation agency. So I'm going to leave it at that, but I think that was an interesting learning for me. So one of the questions, and I apologize, that accredited and non-accredited investor question was from Laura. I misread the chat here. So just wanted to clarify that. Another question from Donald: how do you view the role of mentors as allies and a conduit for minority founders to have access to capital? Well, one thing I will say in terms of mentors and allies, when they move from being just mentors to being sponsors, then it becomes significant. So I think of mentors I've had in the past, and it was kind of like, you sit down, you have lunch, you talk about your career, talk about career moves. Do they approve or disapprove of your given strategies, or they give you some advice, and this is how I did it. And something that I've shared is that if you've not had my lived experiences as a woman, as a person of color, as a woman of color, what worked for you may not work for me. Like, you might go out and golf with, you know, people and bond, and they write you a check, or you might sit up at the bar. I might have a different experience when I go and sit up at the bar with a, you know, prospective LP, or, you know, like, I don't play golf, you know. And so what I would say is that, you know, mentors are great, but if they don't have your lived experiences, then, you know, their advice is limited. But when they're sponsors and they walk you into the room, and they don't just say, hey, do A, B, and C, and this is what worked for me. If they say, hey, I want to introduce you to A, B, and C, I want them to, you know, hear why I'm interested in investing in you, you know, then it becomes really valuable. That's when the ally becomes the accomplice, right? So, you know, ally is like, I agree, I empathize, I feel you, but the accomplice is, I'm going to help do the work to make this change. So I think that's what we need to see more of, because it's nice that you feel me. It's nice that you can see that, you know, I'm having a rough day because, you know, another unarmed Black man got shot, you know, and it's nice that, you know, when I say Black Lives Matter, you don't say all lives matter, because Lord knows I value all lives, but I'm kind of concerned about these ones right here. This house is on fire, so can we like not worry about all the houses right now? That's nice. But when you actually say, hey, yeah, I'm going to actually, you know, help to push forward police reforms. You know, I'm actually going to go and do the research on, you know, why there's not greater accountability so that we can eliminate bad cops and you can believe in the good cops as much as I have all my life. Then it's taking it another step. So I use that as a, you know, hopefully a timely and not offensive analogy, but it's the same thing in the startup space. You know, like, don't just tell me what's worked for you, help to make this work for me, because what works for you does not work for me. I love that. And I wrote that down, of mentoring versus sponsorship. I think that that's a key component in that
mindset shift of what that actually means and the tangible steps that are required to actually like move from that mentor relationship to actually like sponsoring and, you know, being involved in the facilitation of connections and whatnot. Thank you. That was great learning. So it looks like Heather had a long question / comment. This was echoed. It was echoed to me when I asked a VC funding group if they give any extra considerations or opportunities to traditionally unfunded groups like women or people of color, and they in front of her recorded the live group and said no, and she was floored. So I guess there is no question there, but more just speaking to the challenges. I apologize. Yeah, that. But I think that was I'm glad the experience was shared with the group and people can understand those constraints and see how solutions like the petition and the opportunity pledge can open those doors. So
yeah, one of the things that, you know, and I've been on both sides. You know, I started my first company as an undergrad in 2001, so I'm dating myself, but oh well. There was a survey that was conducted by LinkedIn a couple of years ago, and the response from VCs, 40% of VCs said they thought that diversity was talked about too much in the media. So that gives you a little context there. I like to reframe that though. 60% of VCs don't think that it's talked about too much. You know, so the majority, no, it's an issue. There's no imperative, right? Up until this point, there's been no imperative. And I also like to give this analogy. You know, I went to grad school for motion picture producing. And, you know, I was always interested in, you know, film funds and, you know, helping to finance and distribute films. And the most lucrative films are family films. But the films that get made the most are R-rated films. Why is that? Because when you look at who the decision makers are, that's the kind of movies they want to watch, and that's the kind of movies they want to make. And you know what? At the end of the day, they're going to make money no matter what. And they don't care about the money enough to, you know, it's not the sole driver. They want to do what they want to do. And if they're still going to make money, they're going to do that. And so it's the same, you know, kind of scenario in the tech world. You know, if I'm going to make money anyway, I'm going to make money investing in my friends, and you're not my friend. And, you know, when I see a founder of color, it's a little bit uncomfortable for me. I'm not used to seeing that. You know, it's a little bit of cognitive dissonance. There's something in my lizard brain that kind of flames up. I feel some kind of way, like, wait, that doesn't match up, you know? And I've experienced something like that. I shared with, you know, I've shared this before, but I had a friend from Ghana who actually inspired me to pursue entrepreneurship. He worked for what was then Solomon Smith Barney. And I went to his Ghanaian church one weekend. And, you know, I'm looking around at all of these amazing, gorgeous, dark-skinned Black people fresh off the boat, you know, and I don't mean that in a disparaging way. I mean, they're from Africa, and we've been taught that Africans are this and that. There's a lot of divide and conquer even between African Americans and Africans and islanders, right? You know, they're from a Black majority, we're a minority. And I'm looking around, and there are people from Ghana that are wealthier than me, have a better education than me, have better families than me, less dysfunctional families than mine. And I felt the cognitive dissonance, like, oh, wow, this is, you know, I was moved by admiration, but there was a little intimidation there. So just imagine when you've been taught that you're in this meritocracy and you worked hard to be here, and which is true, you know, and then you're kind of shown someone else who's like making you feel some kind of way because you're not used to it. You kind of rather go back to what was comfortable. That's human nature. You know, that's why we invest in people that are like us. So, you know, that what you experience is not uncommon. They don't have to. There's no imperative for them to care about those things if there's no accountability. So that's why we have things like the EEOC that regulate and investigate discrimination. I mean, EEOC did an investigation into the film industry. You know, there's equal numbers of men and women that graduate from the film industry, but only 4% representation among, you know, motion picture directors when this investigation started, and that number has gone up a bit. but they found there was egregious discrimination. I mean, women who were attached to a project when it got approved were taken off and replaced with men. So this is just these are things that happen. We need laws, we need regulations, we need oversight, we need accountability. You know, kids need parents to tell them to brush their teeth. It's just human nature. So, you know, I can understand and relate to that experience, and it's far too common. But there's hope.
There is hope with the opportunity pledge and the petition. There we go. We'll keep giving it plugs as we go. So the next question is more in line with diversity ventures. Question around what's the typical check size that diversity ventures invest and at what stage?
So we are focused on the pre-seed stage right now. That's our model and our thesis. And there's, and more importantly, impact oriented. Social, economic, and or environmental. So the pre-seed right now is around like what that means, and this changes, the ecosystem changes, but right now that's between like 50 and 100,000 for like a first check. So like super early stage, and some room for later stage companies that have more traction and have validated some of their assumptions. And if you know, you tune into Cameron's recordings from the finance panels, you know, I go into more depth on that.
Yeah, well, we have another toolkit series coming up in October, so thanks for the plug. And you'll be getting an ask soon, and I could also ask you in front of everyone, but I'll wait to do that at another time. So the next question is, I've seen burgeoning conversations centered around incorporating more HBCUs as LPs and VC. What are your thoughts on this and its viability to increase diversity on both sides of the VC ecosystem?
Well, I would tell you the pros and cons. So overall, I think yes, absolutely. Like there's a problem that you know, recruiters have not been on HBCU campuses. That's a problem. But I will also say this reservation. So absolutely. There's an organization, HBCU.VC, which was founded by Hadia Mujahid, and she does amazing work. And so, you know, absolutely, they're training up the next generation of VCs coming out of HBCUs. But okay, here's a fun fact. And hold on one moment. Sorry. So when you look at the number of Black college attendees that are in HBCUs, it's less than 10%. So absolutely go after those, go after them. But there's also those of us who are minorities, quote unquote, in, you know, larger, predominantly white and other institutions. And what you don't want to do is say, oh, here's an easy place where I can just dip into this affinity pool, and then you exclude others who aren't part of that affinity. Like I got a scholarship to Howard, and I said, well, I just met my paternal family and I kind of don't want to move across the country, and snow makes me stiff in the winter. So, you know, like I've kind of kicked myself because Howard's such an amazing school. And like, you know, obviously I was interested, I applied. But, you know, I did not go to Howard. Does that mean that, you know, I should be excluded from the pipeline, you know, because I went to Berkeley and helped to expose people who might not have a chance to see people like me? You know, there's that part of the work too. So, I think that yes, absolutely, you should tap into HBCUs as, you know, LPs, as, you know, VCs recruiting. But I also think that you should cast a wider net into institutions where there are people who are underrepresented. And I'll give another, if you look at, you know, Black VCs, you know, that are in the ecosystem now, a lot of them came out of MLT, which is basically a feeder into really prestigious schools and MBA programs, and it's Black and Latinx, you know, really high caliber, high performing, you know, students that are applying to these MBA programs. And that's great that you found a source to tap into, but if that's the only place you pull from, then you're kind of taking a shortcut. So we actually address that specifically in the opportunity pledge, and we say you should absolutely recruit from HBCUs, but not exclusively. We use it as an example, but the one component of the pledge is that you won't like resort to shortcuts. You'll, you know, right, do the work.
Right. Well, that's kind of your point around. It's not necessarily just a checklist to do it, right? It's like, how do you like create fundamental shift in the mindset and the values of these institutions? So appreciate that. The last question I have here, unless some others come in, it looks like another one came in. And we have till 6:30, so about 12 more minutes. This is a question from Laura. She says, the Jobs Act of 2012 felt like it had a lot of promise back in 2012, but in actuality, she thinks it fell flat. It took 4 years to complete the rulemaking on regulation equity crowdfunding. Has equity crowdfunding really fixed any problems? She hasn't heard much of it since the hoopla in 2012.
So I feel you there because, again, you know, I was FINRA licensed, and when I first started reading the laws, you know, I was a film student. You know, I was an MFA candidate in the motion picture producing programs, and producers package films, they get them financed and distributed. They can play different roles, but that is a role that I came into the industry to play. And I remember one of my last classes at UCLA, I transferred from USC to UCLA. There was a panel of producers, and I remember asking them, how did you finance your career? Like, you know, and I'm working 40 hours a week at the Capital Group and, you know, trying to get securities license and originating mortgages. I'm hustling, working 7 days a week to pay for graduate school and cost of living in LA. And I just remember the panel, you know, like most of the guys were, you know, had, you know, privileged career trajectories. And there was one woman, and she said, well, I was married and my husband supported me. so, you know, when I started, that was the era when I started learning the laws and regulations. And at that time, before the Jobs Act, Laura, you mentioned crowdfunding, but that wasn't the big thing for underrepresented founders. Really what it was is that before 2012, you could not raise capital outside of your network at all. And there were specific, you know, rules around that. And so what the Jobs Act did is it allowed for general solicitation, which means that you could advertise beyond your network. So when I mentioned the 35 non-accredited investors, you can't do general solicitation with that. It's limited to your own network. And so, you know, the way that works out is if you have a high net worth network, but you want your mom and your pops and your uncle and your cousin and your, you know, BFF to get in on your rounds, you don't have to prove, if they say that they're accredited, they don't have to give evidence of that in that kind of offering. You don't have to prove that you're accredited. If you say you're not accredited, then it's the issuer's responsibility to say that, to show that that you're sophisticated, right? And so you could lie and say that you're accredited, and there's no check for that because it's truly private. There's no general solicitation. So what the Jobs Act did, it said under Reg D 506C, now you can do general solicitation, but only to accredited investors. So mom, dad, uncle, cousin, BFF, Pookie and them, they can't invest in your offering unless they can prove that they're accredited, because under general solicitation under Reg D 506C, you have to prove that the accredited investors are indeed accredited. And so they have to show tax returns, W-2s, or they can get a CPA or a lawyer to sign a letter that I've looked at those items and I can attest that they are indeed accredited. So there's that burden on the issuer. But you can advertise on the radio, you can advertise on LinkedIn, you could do any of that. But you can see how it limits wealth creation in one's own community because you can't include your actual friends and family. And so I don't think that that's an accident. And then the other alternative, as you mentioned, is Reg CF, where you can also do general solicitation and you can have non-accredited investors. There are a myriad of rules, and I have an infographic on the Tech Funding Equity site that shows, you know, the typical startup offerings, and it has Reg D, and it's just very, like, it's pretty simple, you know. But there are limits in how much you can invest as a non-accredited investor. You can invest more than 5% of your annual income. Unless you make over $100,000 and it's up to 10%, you can't invest more than $107,000, even if you are an accredited investor. There's limits to how much you can raise, and there are people who have been pushing the SEC to lift that limit, and the SEC is considering it. But there's a lot of hoops you have to jump through. You have to have your financials audited. The earliest stage companies are not going to even have revenue or, you know, you're not going to get any insight from auditing financials of a really, really early stage tech company or startup in general, but it's an expensive process and the legal fees are higher than there's the marketing fees. So I mentioned earlier, it doesn't replace a friends and family round. And another thing is that it has to be done on a registered platform. There's a very limited number of registered platforms and they have discretion on whether or not to let you in. And they typically have thresholds on revenue, et cetera. So again, really not for replacing the friends and family round because you have to have already hit certain milestones that most companies at that round won't make. Has it made a difference? Absolutely. So if you know people like Howard Hughes, I just did a panel with him. Kwame Anku has worked with several founders who have done crowdfunding. I know that we have like Dia Wilson here locally with Lifograph who has done crowdfunding. You know, I would say for a lot of these founders, it has been transformative in infusing them with cash, but it's not equitable. It's a separate and unequal opportunity to raise capital, and it's falling short of meeting their needs. And it's constraining capital formation and it's constraining wealth creation. And when you look at like the typical Silicon Valley company, they're not going to do crowdfunding because why would you want to go through all those hurdles if you can just do a Reg D 506B or C? And who's going to do those? People who have enough high net worth people in their network to do a B and bring in their friends and family, or, you know, who you have enough in their network to do a Reg C and want to don't mind excluding their friends and family to open it up to a wider pool.
All righty, last question, and then from the group, and then I have one kind of last question to end it, and we have about 5 minutes left just for context. And this question is around your thoughts on meritocracy. Do you think meritocracy is actually dead?
Meritocracy? Do I think it's dead? I don't know if it was ever alive. You know, I don't know. Like I subscribe to it, to be honest. You know, I'm learning too. Even in this tech funding equity project, I knew about redlining. I didn't know when it came about, and I didn't know about the explicit language. There's a lot of things that I learn every day, you know, about the experience of, you know, even my ancestors, you know. But I, at one point, felt like I emancipated from foster care at 17, okay? You know, I've had a modicum of privilege. I'm mixed. My mom was white. I learned standard English, you know, I had GATE classes. I grew up in a safe community for the most part. But you know, I thought, hey, I've made these sacrifices and did this work to get these opportunities. And if other people do it, they can, you know, they can get where I've gotten. And what I realized the older I got and the more life experiences I had is that there are so many barriers. There's so many iniquities that I don't think that we can really apply meritocracy. You know, I mean, are there people who are gifted? Absolutely. And I don't think they even have to have gone to college or, you know, I mean, I see brilliant people, you know, I've seen brilliant people with PhDs. I've seen brilliant people with high school degrees, you know. So, you know, I just think meritocracy is abused. And I think that's given it a negative connotation. When it comes to what makes for a good startup or a good investment, I don't think it necessarily has a pedigree, you know, so I'll say that.
Thank you for that. Well, in closing, my last question, and always like to kind of turn it back, is like, what can we as a community do to support you in moving this initiative forward? And then what's the best way for people that are either here today or watching the recording able to support you and get a hold of you?
So you can get a hold of me at mariah@diversityv.com. Please bear with me. Don't take a non-response, as you know, I have to prioritize and things fall below the fold, but I do try to be responsive. And I've shared on one of the toolkit series that I actually, if you look at the number of cold inquiries I respond to and take meetings from versus those that come from warm introductions, I take way more cold intro meetings. But if you look at like the percentage of cold intros that I can respond to versus the warm intros, I respond to like every warm intro, hopefully. But it's, you know, less likely the cold because I'm human, I have 24 hours in the day, I have a kid, I have a husband, I have to rest and sleep and breathe and eat. So just keep that in mind. But mariah@diversityv.com. I'm at LightedStar on Twitter. I'm on LinkedIn. I do try to check in on a regular basis. Sometimes those messages flood. In terms of support, subscribe to Tech Funding Equity. Read the content. I tried to make it easy to understand, but if there are things that aren't clear or that you have questions about, please do let me know, make a comment, reach out to me, because I'm doing this for us, and so that's helpful. It won't hurt my feelings. And there's a petition to change the accredited investor definition. I put forth both some arguments and a lot of research in the reference area. So, avail yourself of those tools. I spent a lot of time going down those rabbit holes and trying to make it easy for you. So check those out. Check out the infographics. I put a lot of work into them, and I did them to distill down the research and experience that I've developed over the years and give them to the world. So please, don't let them be there in vain. And if you see a typo or, you want to know more, then again, reach out to me. So, and I do want to say one thing. After the rule came out with the SEC, the Small Business Capital Formation Advisory Committee, they had actually done a meeting on August 4th about how the SEC is serving underrepresented founders or not. And that meeting is posted on their website. And if you follow me on Twitter, or follow Tech Funding EQ on Twitter, I post some of these things, and I'll be rolling out more, and I'll be making additions to the website to include like some of the videos and whatnot that I've been gathering. But please follow, and please level up on that so that we can advocate together. But the Small Business Capital Formation Advisory Committee did this meeting. They put out a recommendation after the accredited investor rule came out, and it was very specific that, hey, the current regulations are not addressing the needs of underrepresented founders. And they also put out a little short video about the accredited investor definition, and they are taking ongoing comments about this. So that's how you can support. And it's not just for me, it's for all of us. It's for closing the wealth gap. I mentioned that 300 billion in collective income and this 9 million jobs that we're losing for discriminatory financing. But I also just want to quickly say that McKinsey & Company came out with a study recently that showed that closing the racial wealth gap will add over $1 trillion to our economy and increase our GDP 5 to 7% within 10 years. So this is really, it's for all of us. We've all been hoodwinked. And that's why I will say to the white guys, and my stepdad was white, my grandpa was white, my uncles, my cousins, I love white people, my mama was white, okay? So this is not, again, a name, blame, shame type of thing. This impacts all of us. We're all losing because of systemic and persistent racism in all of its forms, and we all are programmed by it. So let's do this work together. Let's lean in together. And I appreciate all of you for tuning in.
Thank you so much, Mariah. What a great presentation, and just thank you for spending the time with us and sharing your experience and expertise and just leading the charge on this super impactful work. So I'm appreciative to be a part of it, and I'm looking forward to the continued work. So thank you, and we'll call it an evening.
Thank you, Cameron. Appreciate you. Bye, everyone. Thanks for your great questions.